Alrighty then, hello everyone. We're just coming to you real quick with a market update, just to kind of see where things are, and then we're going to roll into where we are likely going. So first things first, let's look at this historic S&P 500. We're pushing up into new highs. Everything is beautiful and hunky-dory. So as we've talked about in previous market updates, what is driving this market higher and higher and higher? Well, I bet you it has something to do with the reverse repo market, as we've talked about before. This is the piggy bank that has been funding the US Treasury market. And what's been great about this is it's telling us exactly where the market's going because there's liquidity coming into the market. The only time that we've actually seen down pressure in the markets has actually been when the reverse repo market has actually been trending sideways or up, right? Since it's been draining back here, you've seen that markets pushed artificially higher. It started to stall out for a little while. We got a little contraction, and then they started draining again. The market actually pumped up just a little bit, right? And stalled out for a little bit. And then as soon as it started going sideways again, boom, we fall down. And the story rinse and repeats, rinse and repeat, rinse and repeat. And then all of a sudden, it just goes on a tear. We're just full solid draining. Well, why is it going in full solid draining mode? That's because the amount of money needing to fuel the auctions has been steady. And then all of a sudden we get down here to this low end where the amount of auctions, or I should say the amount of money being auctioned in treasuries, has slowed down for a little bit. So maybe we're seeing a little bit of slowdown in spending momentarily, but likely what is going to happen is that the U.S. government will kick up their spending again and start cranking up the auctions and drain this guy all the way down, right? Down here to zero. That's the zero mark right over here. You can see that. So zero mark down here. Well, that way they fully suck this account dry. And then by that time, we should actually see a higher pushing up in the S&P if that ends up happening. And then at the same time, we also will likely have the Federal Reserve here. We will likely have the Federal Reserve stop their quote unquote balance sheet runoff or tightening that they've been doing, where they've been selling securities, even though we know they haven't really been selling securities because the money in the background has actually still been pumping in. So they're net still expanding the money supply. So what are we going to do back here? Well, as soon as this guy gets finished draining down here, so as soon as he hits down to the zero mark, likely the Federal Reserve will either do one of two things: either stop and let the markets deal with the fact that there's not enough money out there to deal with the spending, or the government's going to have to slow down their spending, and then we'll likely see some sort of economic contraction. Or they ramp this back up and basically take the place of what the reverse repo market was doing and keep the money supply continuing to flow, and then asset inflation would continue to go as well. So either one of two scenarios is going to happen. The Federal Reserve is the one playing the game right now, and so we've just got to figure out what they're doing. As long as they're doing what they're doing, though, they're printing, they're allowing this to continue to work through the markets, and higher markets are likely. Now, with that said, is that we are starting to see, for the first time in a while, we are starting to see the reverse repo market starting to trend up again, or at least flatten out, right? You can see this overarching curl is slowing down, right? If the government doesn't continue to crank up its spending and really produce these auctions, then what'll happen is that the excess liquidity will not be needed, and then therefore the money supply won't actually grow. If that happens, then we could actually see a rollover sooner rather than later. So always keep an eye on this guy. And that is our first telltale sign if the liquidity is still being provided. And then, of course, we can always look at the balance sheet from the Federal Reserve. Now, with all that said, let's look at our other brothers and sisters. So Mr. Dow Jones has been cruising along right next to the S&P 500. We're just going to kind of grab from the lows here, and been keeping pace for the most part. Not quite as high as the S&P as a whole, because the S&P is a little bit more tech heavy, and that's where a lot of spending has happened going into Silicon chip spending and shoring up all that and energy and stuff like that. So then we go into small caps. They have definitely not been feeling the same stimulation that the rest of the market has, but it has pushed into relative new highs, even though they are far off of their all-time highs. As you can see way back here, they're still low. They're still, let's see, roughly 6% off their highs, 6 to 7% off their highs. So we've still got a little bit ways for the Russell to go through. If we get an actual economic expansion at the end of this, the Russell will actually tell us, and this will start to push higher and stronger. And then, of course, we also have the NDX, which is really like tech as a whole. Let me just add that in here. And the NDX has been the powerhouse, right? As you can see up here, this thing has been cranking straight up. Look at this, 62% from the bottom. This thing's been a beast. And the reason why this is because exactly what I said. A lot of the spending has gone directly into growth and AI and silicon chips, and that's where a lot of that spending has happened, just to cut that short up. And so US-based silicon and US-based tech firms have really been pushing up. Plus, there's been a little bit of an AI bubble. So yeah, where is things likely to go from here? I think that that's where everyone's question normally is. Like I said earlier, if the reverse repo market down here does continue to stabilize or grind up a little bit as the government stops spending as much, just momentarily for a little while, we will likely see a pause across all stocks, and a little bit of a slowdown will happen until the Federal Reserve starts quantitative easing or cuts interest rates or tries to stimulate the economy in some other fashion, as far as right now. But that's kind of likely where we're at. On a technical basis, we are very topped out, but this isn't a technically driven market, right? This has been a printing or a monetary expansion led market. So that's what we look for to see where things start to slow down. On the macro side of things, as you can see here on the Adapt Advanced metric that is available to those members, the macro environment is a neutral. We were neutral bullish. Before that, we were bullish. We were been like this for quite a while, but the macro environment is slowly starting to transition into a more neutral environment. Now, this can flip from week to week. That macro environment changes from week to week, but overall, slowly but surely, we have been going from bullish to neutral bullish to now neutral. And then hopefully, or I should say, relatively speaking, we should go to some sort of neutral bearish or even a bearish. As far as our risk to the upside and the downside, a relatively symmetric, right? 83-point move up, 85-point move down in the S&P. So nothing too crazy there. We're relatively in this more neutral land. And so things are starting to work out pretty well in that regards. As far as our general market behavior, right? Historically, this market has small pullbacks, stable average weekly ranges. Everything's really slow and calm. That's exactly what we've been getting. We've had this up on our indicator for a very long time. And then we've also had this up here. Typically, there are excessively bullish monthly trends with quick, vicious, shallow pullbacks that only last for a few days on average. And new highs are common. That has been showing up in this metric for the last 6 months. And boy, has that ever been right. That's exactly what we've been getting. So overall, more of what we've had recently is still in the cards, but we are just slightly starting to taper off and slow down. All right. With that, guys, trade well, make a ton of money, have a good time. I'll see you next week.